Okay, next slide, Harry. So we also looked at earnings before taxes, EBIT, which has been a big ratio people have looked at, saying this is the best fundamental value measure of stocks in the Dow. Well, here's the Dow. Here's the best EBIT ratio. Here's what I just taught you. Obviously, low price, 12-month forward P ratios knocks it out of the park. These stocks, go to your room. They don't do as well. So while EBIT's a big deal and it's been really bandied about a lot, it doesn't outperform the simple little 12-month forward PE low price stocks. So if we look at the quarterly returns of what I've just shown you, going back 103 quarters, that's back, what, 25, 30 years, something like that, this gets very interesting to me. This is the return each quarter of the strategy, the 5 lowest price stocks with the 12-month forward P. A little bad time. We're down 1, 2, 3, 4 quarters. 1, 2, 3, 4 quarters. 1, 2, 3 quarters. So if you're down a couple of quarters, you probably want to get back in the system. Notice the bear markets, as we saw earlier, don't last very long, do they? But our fear that we all have, this cognitive bias of the big bear market, is they don't last forever. They last about a year and a half, and it's all over again. So again, we see the importance of being very bullish when things are very bad and realizing bear markets really don't last very long. So when we come back from lunch, we're going to look at a technical-only price strategy for you technicians that also does pretty well. Not as good as this, it does well, but it doesn't use any fundamentals. But it's about time for lunch, so I think what we'll do is, Harry, if I could sit there for a moment, I'm going to pull up FinViz. How many people know of the FinViz site? Okay, about half of you. So we're going to go to FinViz for a moment. Bear with me while I try to, are we online, Harry? Ooh. I'll let you work on that. While he's doing that, I will talk a little bit about the price-only strategy. One of the best strategies, investment strategies, have been to buy the strongest stocks, called relative strength. The original work was done on it by Robert Levy in the 60s, and George Chestnut did a lot of work on it. And basically, stocks that are strong continue to stay strong. Dorsey Wright has done a lot of work on it as well. Strong stocks continue to stay strong. So I took that idea and tried to work on that in the Dow because I want to buy in blue chip stocks. I want to narrow down from 16,000 to 30 stocks and looked at buying just the stocks that perform the best on a technical basis, relative strength. And in fact, we found that it works. It doesn't work as well as fundamentals though, and it does work. So the strategy of buying high-priced stocks works, but here's what makes it work better for those who like technical stuff. Here's a group of stocks. This one's done this, this one's done this, this one's done this, maybe this one's done that. This one would be number 1 because that's the highest gain from here to here, right? Okay, so that's relatively the strongest. What everybody does is they buy this stock and maybe this one and they don't buy these at this time period, every quarter or whatever the time frame is. Did a lot of tests on that. Yeah, it beats the market, but I took it one step farther. Have any of you ever bought stocks way up like that? And they go down, don't they? So, okay, I know that's what happens. So at this point in time, we bought the ones that were the strongest 1 month ago, not the ones that are the strongest now, because the 1 month ago I've probably done this into my buy point. And that group of stocks outperforms this group of stocks. So I want to look at not the strongest now, but the strongest a time period back, a month or 2 months back, because they've had the run up, they've had the drift down, and they're probably ready for another run. So those of you who are doing a lot of relative strength stuff, I would suggest you stop doing the leading ones and get the ones back in time that were the strongest, because they outperform the ones that are strong right now. Because the ones that are strong right now are ready for a little correction in the marketplace. Sometimes a big correction, and sometimes just a little correction, or they stall, whereas this is ready to turn back up to the upside again. So that's was one of our breakthroughs in doing relative strength tests on stocks in the S&P or stocks in the Dow. So you relative strength guys, this is a big breakthrough. It's really simple. As I guess all the breakthroughs in technical analysis, all this stuff is really pretty elementary stuff. There's nothing rocket science about it. It's just if you think about it a little bit, yeah, that makes sense. And that's how we came up with the idea. And it does test better. Yeah. Please.
When you buy the 5 stocks, you divide the amount equally.
Oh, we're going to get to that, but I guess this is a good point to get to that. Here's a big question. If I've got $1 million and I'm going to buy 5 stocks, do I buy equal shares of each stock, or do I put equal amounts of money in each stock? Big difference. You want to put equal amounts of money into each stock. Don't have equal shares of each stock. You'll see in the presentation at some point we'll stumble through this. Thanks, Harry. We'll stumble through this and you'll see that you make about 3% more by putting equal dollars into each stock as opposed to equal shares into each stock. And there's a mathematical reason for that. Okay, so here's FinViz. This is the website. Thanks, Harry, very much for putting us up here. And we're going to go to the index right here. Well, we're only interested in the Dow Jones Industrial Average. We're only interested in 30 stocks. Then we're going to come over to valuation. Ta-da! And we're going to look at all the value. Look at this. Market cap, PE, forward PE, price earnings growth, price sales, price book, price of cash, price of... Everything is there for us. In the old, I had to go to the library and go through Value Line books and stinky old libraries, record all this by hand. It took forever. And now, click of a button, I have it all. It's remarkable. Evolutionary economics, things get better. Okay, so, well, we got the fundamental screen. Now, they do have a financial screen, market cap, ROEs, all that stuff, ownership, who owns the stocks, the float, outstanding, how much insiders own. So if you want to see what stock has the most insider ownership in the Dow right now, it's going to be Walmart, and then Microsoft, and then Goldman Sachs. You can look at performance. That's going to give us some relative strength. You want to be a technician, you can go there. They have all these things, but the only one we're interested in is valuation. And then we want to go over here to price. We want to sort by the lowest price stocks. Well, there's the highest, Goldman Sachs at 185. Oh, that's out of our league. We're poor boys. Oh, look at that. There they are, the 5 lowest price stocks in the Dow, or the 10 down to JPM. That's the group of stocks we want to beat up on. Then we can look at price sales and all these other ratios, but if I come to forward PE, there they are, the 5 lowest, 5 lowest price stocks in the Dow with a positive forward PE.
And that's a 12-month PE?
That's a 12-month forward PE, right.
So do you choose the highest PE?
I'm sorry?
So do you choose the highest PE? I mean, because you've got 9 stocks there.
Oh, well, no, I'm just looking at these. I'm looking at these 5 right here. Now, I will do this. Right now, I go, oh, wow, Microsoft is $43 a share. Coke is $38 a share. The P is a little higher in Coke, but the price is a little higher in Coke in Microsoft. Sometimes you'll see a big difference here where the current PE is like really low, maybe the 6 stock. So I'll take 6 instead of 5. I mean, I'm willing to do that. If there's a big difference between the forward PE ratio and not much of a difference in price. But as you can see in our price column over here, we're all generally in the same price. So I'll do that a little bit. Now, when we program, we couldn't tell the computer to do that. Oh, look at these. But as a general rule, I will intervene a little bit and say, well, let's use some sense here. If there's both the same price and one has a lot lower forward PE, I'm going to take that one if it's number 5 versus number 6. Other than that, I'm just going to buy those 5. That's what the computer did.
Lower forward?
I don't really care about I don't care about this column unless I see a big difference between stock 5 and 6. And there's not much of a difference here. If this was, yeah, if this was 30 and Microsoft was 14, yeah, I'm going to kick Coca-Cola out. But now there's not a big difference in the lowest forward PEs here, so I'm happy with Coca-Cola. That's the group of stocks we're going to be in for this next turn in the market. I won't do that until after the last day of September. So the last trading day of September is the end of the quarter, and then I will find this group of stocks, and it'll probably be this same group, and that's the group of stocks that we will be in for the next roll. The current stocks, we'll look at what the current positions are, and we would kick out any stock in our portfolio that's not in this group of 5 stocks.
So you get out on the 30th and in on the 1st.
I'll get out on the 1st. I'll do everything on the
Get out on the
1st, yeah.
1st.
And even then, as we pull up, let's say we have to get out of GE, or we want to buy GE. That was still, in my heart, I'm a trader. So I don't just buy on the opening. I'm going to try to buy a little better. And I'll use some trading skills. The market's overbought, oversold. I won't just jump in and buy them. You could do that. After all, that's what the computer did. The computer just bought them automatically on the opening. But as a trader, I'll try to get into my positions. I'll keep orders below the markets for a few days, trying to buy on some weakness. The ones I have a profit in, I'll actually hold, try to buy it, sell them on some strength if I have to liquidate a position. So I still use some trading skills and abilities, but generally speaking, by the end of that week, I really want to be in the new group of stocks. So you can still use some trading skills and techniques to do that. But there's a group of stocks. Those are the ones we know outperform the Dow. That's it. Not nice, so simple. Question?
What about earnings? How do you handle earnings on your?
I don't handle earnings. I've already screened for the lowest 12-month forward PEs, and I'm happy with those.
So you just taking this as a blank?
I just take those. There are so many tests you could do and run, and we have.
I'm talking about earning dates.
Pardon?
What if earning was that week?
I'm happy at the end of the quarter, I've got my forward projected earnings, right? These hot shots went to Wharton. They probably know where the earnings are going to be.
You're also dealing with the Dow too, so volatility is not as strong.
Right. So I take these numbers, and again, in part because that's what the computer did, isn't it? That's what the computer did. The computer didn't care about who was in office, what money supply was. We just bought the 5 lowest priced stocks with a 12-month forward P ratio, and we found those knocked the socks off every other system strategy that we could come up with. So I'm good to go with that as a basic strategy. Please.
Do you combine this with the strength of 1 month ago?
Do I combine this with trend? No, that's way too complex for me. I like buy the stocks, hold on to them.
But then you get the fundamental as well as the technical.
You could do that if you want to take that to another level. But for my friend the dentist in St. Croix, or for most people, you just want something really simple. Buy stocks, buy them, and roll at the end of next quarter. It takes about 5 minutes a quarter. Yes?
On your rate of return, do you consider the dividend?
On my rate of return, do we consider the dividends? No, not in what I've shown you. So your rate of return is actually a little bit higher. In all the tests that we didn't count dividends into it. We just did price change. So that's it.
I'm unclear on one thing.
Mm-hmm.
If the prices are relatively similar, but there's a big difference in the forward-looking
P.
price-to-earnings ratio, you choose the lower price-to-earnings ratio?
If there's a big difference between the PE ratio, I want the lowest PE ratio, clearly. So far in my memory, I think I've seen that once or twice where there's a big difference between PE, so I'm going to default to the lowest PE ratio because I know those stocks outperform high PE ratios. But for the most part, it's going to be the same thing all the time. So that little simple strategy has done 20% a year without market timing. And you know, with market timing, what we can do, we can get out of some of those big down drifts when we have recessions or it looks like a recession is coming, go flat, be in cash, and wait for a 13-week rate of change buy signal or another buy signal that I'll teach you after the lunch break. And I think it's time for lunch break. If you have questions, I'll stay in the room here for a while. And I forget the schedule, but you know when it is. Come back from lunch and we'll start again. We're going to get in a little bit more timing, a little bit more selection, and then trading stocks.